Sure, thanks. Morning, everyone. We'll just take another minute as we see some more people joining in. Right, I think maybe we can get started. Morning, everyone. A warm welcome to all of you to this webinar on demystifying CbCR practical insights. My name is Deepak Agarwal. I'm an associate partner with WTS Dhruva based out of Dubai. I'll be the moderator for this webinar. So globally, CbCR got introduced in the year 2016, and it's been 5 years that large MNCs have been filing their CbCR compliance reports. UAE introduced CbCR in financial year 2019, and last year UAE-based MNCs did have to file their compliance report. So it's actually the second year as we step into 2021. If you look at the agenda, what we plan to do today is we'll just spend some few minutes on what is CbCR. Then what we intend doing is dig deep into practical insights and statistics and economic outlook. And we've got a good experienced team in terms of, who've handled CbCR reporting for global MNCs at various country levels. And what we intend sharing is how do the tax and regulatory authorities look at these reports, what kind of questions do they pose, and especially now keeping in mind that we have BEPS 2.0 Pillar 1, Pillar 2 coming in, what kind of thought process the authorities or what kind of review points these authorities will have when they look at these reports. The other part would be around some steps, what steps a company could look at in terms of, handling or filing of these reports to ensure, whatever practical insights we share with you are kept in mind that you file, that you need to adopt before you make your compliances. And the final bit, if we get some time, we'll be happy to kind of pick up some questions. Some housekeeping rules. If there's any technical issue, please feel free to write into the chat box and our technical team will connect with you. Again, if you have some question, feel free to write into the chat box. And please note the webinar is getting recorded and we'll be happy to share a copy of it after the presentation. In terms of speaker, we've got a rich experience over 30 plus years. Aditya Hans, who's a partner with Dhruva Advisors, and Kapil Bhatnagar, who is a director with WTS Dhruva. And I'm sure they will be kind of definitely demystifying the practical challenges or the insights from a CbCR reporting perspective. Aditya, Kapil, over to you.
Thank you, Deepak. I'm sure all the listeners of today's session, they would have gone through umpteen number of webinars on what is CbCR. Well, UAE has completed 1 year of compliance, so it's not something it is new to anybody. But yes, what will be new today will be the outcome of the data points which have been in 2016 filings and 17 filings. These data points have been collated, aggregated on an anonymized basis, and the OECD as well as the IRS has given an outcome. I would look at the IRS because, interestingly, IRS in Japan actually, if we aggregate the numbers of the CbCR filing which has happened in these two countries in the year 17, they would be something around more than 50% of the CbSR filings across the world. So that also indicates that 50% of the headquarters are residing in Japan and US, and US being the dominant in that, US being two-thirds of that 50%. So roughly 35% of the total CbSR filings have happened from US. And obviously we have the data point of OECD itself. So that is the attractive point, that is what have been the findings, what have been the inferences. But before we delve into that, I want to spend 15-20 minutes doing a quick recap. I would also want to tell you small, quick stories about the origination of all of this. Because, what's been told to all of us is that it is an act to implement to combat harmful tax practices. But when did the world wake up to this? It was only in 2008 when there was a financial meltdown and tax revenue collections were going down. And when there is a chaos across the world, then you start making allegations towards each other. And when the allegations were so high, the only way they could pinpoint is that, okay, the tax rules have been drafted, the international tax rule, the cross-border tax rules have been drafted in such a manner, there are tax leakages, there is a stateless income which is never getting taxed, and that was a story sold. So post 2008, countries woke up, and in this context, taking that as a garb, that tax collections are going down, but actually it was a financial meltdown. Tax collections are going down, and putting an allegation around that it's due to tax evasion. Thankfully, it's a good thing which happened actually after that the world woke up, that the last time when all of them sat together and redrafted the international tax rules was a century back. So today's sharing and gig economy and the digitized economy, probably the current tax rules are outdated. Everyone was aware of it. There were discussions, but there was never a cohesiveness. There was never a togetherness of all the countries, the primary 100 odd countries, 120, 130. Interestingly, if you would see that there are 137 countries who have agreed to be compliant with the CbCR. So 137 countries came together. So many countries coming together, signing, agreeing. It was triggered in 2008. So as a result of that, 2008, in 2013, 15 action points were agreed upon, that they will work upon these 15 action points, which were finalized in 2015, of which 15, there were 4 minimum standards which were agreed upon, that come what may, these 4 will be implemented across the world. And as we all know, the pillars of these 15 action points were transparency, substance, and cohesiveness. So the transparency being one of the key elements of this pillar, the transparency documentation CbCR is part of the transparency element of that. So taking the context of transparency, CbCR was introduced. Now CbCR has its own interesting story to say, and I'm going back, because the origins, you would see that it is just not a good tax. It is actually not a good tax tool. So although I'm doing a webinar on CbCR, but I'm saying that if you look at the origins are nowhere associated too much with tax. It was actually an accounting. So way back in 2003, a similar format of disclosure was decided, and it was a discussion that it would be a public disclosure and it would be part of the accounting standards. But post 2003, somewhere it got lost, and sometime around 2011, the G8 actually brought it up that we would want this kind of a reporting disclosure. Now, somewhere between 2011 and 2013, it found its way into the TP documentation as CbCR, that is the Action 13, which is on transparency. Somewhere it found the way, how, no one knows, but it was actually a suggestion of the G8 in 2011. And initially, when it was thought about accounting. In 2011, it was thought about a tax risk assessment tool. And when it found its place in the action points, it became a transfer pricing risk assessment tool. And I will discuss in the subsequent slides that it is actually a very poor transfer pricing risk assessment tool. But it was a disclosure which had to be done. whatever Lord OECD, the G8, the G20, and the 100 odd plus countries, that they could agree on a template and come together on this and agree on it, and they are exchanging information. So that is the feat. So that is the achievement which has happened. Kapil, we could move to the next slide. Now that I've given you a story, now focusing on Action 13, it is split into three things. One is master file, which is a broad overview of the group. Second is the local file, which has already been there. It's just that it has been upgraded, factoring what the OECD has suggested. This was already prevalent in more than 100 odd countries. And there's a single CbCR report which has to be filed. And by way of double tax conventions, by way of tax exchange information agreements, by way of bilateral and multilateral competent authority exchange agreements, the CbCR report, which is filed at one ultimate holding company location, is exchanged with all the jurisdictions. So there is a very complex framework around the CbCR. Why? As I spoke in the start, it is to start with it was all linked to transparency, because one of the pillars of the 15 action points was transparency. What they wanted to achieve, somewhere they wanted to achieve, and they wanted to see whether the value creation which is happening across the world, the economic activities which are happening across the world, whether the tax rates are aligned with that or not. If I look at the template, and I will move to the template after this slide, you would see that one of the most critical elements is missing in that. And interestingly, again, I missed one part of the story, that there was in 2013, when it became a proposition to be made part of Action 13. In 14, if you would see, there was a draft template which was a lot more intense and extensive, but somewhere a diluted version came up in 2015 document. So there is a story behind it. There's a journey of the CbCR starting from 2003 to 2015-16. Kapil, I would want to go to the template, and here first I would want to criticize this template. Reason being, what is this template? It's about 9 numerical data points, and when you plot these data points on for each jurisdiction, you aggregate the data, and then you start looking at what is the profits in a particular jurisdiction, what are the taxes paid in a particular jurisdiction, and you compare it with the tangible assets in a particular jurisdiction or the number of employees in a particular jurisdiction. So you try to justify that if there's a particular top line, there's a particular profit percentage, and is there profit between all the locations put together. So assume there's $100 of profit spread between 10 locations, and if one location has $30 of profit, whether they are adequate number of tangible assets or adequate number of employees to justify that $30. But one important element which is getting missed out here is this whole template does not have intangible assets. The moment you don't have intangible assets out here, you're beating the arm's length principle. So how can this be a transfer pricing risk assessment tool without intangible assets being recognized? I agree, the difficulties, intangible assets in the books of many of the companies will not be valued appropriately, but without intangible assets, this data is meaningless. So it cannot be applied in an arm's length principle scenario. But yes, if you apply a formulary apportionment method, this is a very good template. So actually this template, if you see, this template defeats the arm's length principle and proposes a formulary apportionment. Thankfully, IRS and the Dutch tax authorities and many other countries, all of them, they woke up to this, and they came out very strongly and clearly that this may be a transfer pricing risk assessment tool, but this will definitely not be a document for a transfer pricing conclusive adjustment. This may be a risk assessment tool. That means this will give an indication that you need to move into a little more in-depth study. Kapil, I would want you to move to table 2, and I will just take another 2 seconds. Look, there are no numerical data points out here. It is just subjective data which is there, or qualitative data. No quantitative data is there. So you have to give the TIN number, that is a tax identification number, the entity's name, and the primary economic activity which they are doing. That is which has to be provided. Interestingly, there's a mention of intellectual property, holding company intellectual property, and I would want you to look at a particular element which is out here is if you see other holding, there's a dormant other, the third last one, holding shares and other equity instruments. In the subsequent slides, when you will see that when OECD has come up with these observations, it is found that investment hubs have the maximum exposure to holding shares and other equity instruments. So this is a very interesting observation we'll see in the OECD findings. Kapil, we can go back to the slide. I will not spend more time on the CbCR why and what and where. Reason being, I think so, all the listeners would have heard about it over the years. The evolution I've already discussed, but I will tell you standing today, they have 84 countries who have implemented it. 5 countries, their draft rules are there. And I can tell you, I read a 2020 OECD report that out of 137 countries in the inclusive framework, just to give you an idea, what is the inclusive framework is that you may draft a very good law and you may ask all countries to implement it. But whether they are implementing it properly and appropriately and then having an appropriate use, or whether the local laws have been adapted in a manner to absorb those amendments. So there's a peer review which is undertaken, and the 137 countries are signatories to the peer review for CbCR. So 137 countries, the G20, the OECD, and the countries outside both of them, all of them on an equal footing will do a peer review of the countries and say where do they stand. And as basis the last peer review, I think so 90 countries have implemented it. Roughly 40 countries have the draft rules, and 6-7 have opted out because they don't have any headquarters in their country. So with such detailing, so many countries being participating in this, that means there is some sense to it. Although calling it a transfer pricing risk assessment tool, I am reservations on that. Kapil. And here, Kapil, why don't you speak about how UAE has coped up with this in this whole journey from 2013 till date? Please, yeah. Kapil.
Sure. Thanks, Aditya. So the UAE jumped on the BEPS inclusive framework somewhere around 2018. That was the time when UAE formally committed itself to the inclusive framework, and that's where the entire regulations on CbCR, Pillar 1, Pillar 2, they started thinking about it and said that let's look at more tax transparency in the region. That was one of the key focus areas where the global economies were pressurizing the UAE to really focus on. Once that was done in 2019 is when UAE introduced the CbCR regulations in the region. Those regulations were further replaced by another cabinet resolution in 2020. The regulations and the implications and the applicability was substantially made more business friendly. It was only targeted or applicable to companies which were UAE headquartered multinationals. So if you have a multinational enterprise which is not a UAE headquartered, there was no CbCR compliance for that entity in the region. Interestingly, also, like Aditya just mentioned a few minutes ago, that a full-blown action plan 13 framework talked about a master file, a local file, and a CbCR filing. UAE, known for its business-friendly, framework and mindset, didn't really push for a requirement of a master file and a local file to be done in the region. So they just focused upon the minimum standard being prescribed under the OECD, have a CbCR filing, and do not really have a master file and a local file in the region. So like I said, it really is applicable to UAE headquartered multinationals. The threshold is a global threshold which is being prescribed by the OECD and picked up by the UAE authorities. The global threshold is 750 million euros or more, which translates into a 3.15 billion dirhams. of an immediately preceding year. So for example, we are in 2021 right now. I need to do a compliance for 2021 in terms of whether CbCR is applicable to me or not. A group should ideally look at their consolidated financial statements for 2020, see if that turnover thresholds breaches 3.15 billion dirhams or not. If yes, the CbCR compliance requirements would be applicable. They are twofold. A notification needs to be filed and a report needs to be filed. The notification is due before the end of the fiscal year. So the 2021 notification would be filed before 31st of December 2021, and the reporting for 2020 would be done again by 31st of December 2021. So that's how the timelines and the structure of the regulations are prescribed. In terms of the content, notification is fairly simple. It's something which is very, very easy to complete. Like we discussed, it is only applicable to UAE headquartered multinationals, and accordingly, they just need to declare that yes, they are the ultimate parent entity of the group. They are a resident of the UAE, and the CbCR requirements are applicable to them. Yes, the general information on trade licenses, business activities, etc., need to be filled in, but the notification is a fairly simple document to be filled in by the companies to inform the authorities that CbCR regulations do apply. The CbC report, on the other hand, is like Aditya just mentioned, is more of a descriptive template which needs to be filled in. There are 3 tables, table 1, 2, and 3. We discussed table 1 and 2. Table 1 is more of a quantitative data or financial numbers to be reported. There are certain lacunas, like Aditya just mentioned, which should ideally be a part of that table. But table 1 really comes from the consolidated accounts and your internal accounts, and that data is to be reported. Table 2, on the other hand, talks about the entities and their business activities and how does it really pan out, from an overall group perspective. If there are any additional information which needs to be filled in or needs to be informed to the authorities, a provision of a table 3 is given, and a company or a licensee can really go ahead, fill those additional information in table 3 and inform the authorities. There are stringent penalties, and the FTA and the MOF have been interestingly very, very aggressive. While it's just the second year of compliance, traditionally, the first year of compliance, the authorities have been a bit more lenient in terms of errors, in terms of any misinformations being reported in the CbC report. They've gone back to the companies, given them enough time of, let's say, 30 days or or even more to rectify those errors. But yes, as we see, as UAE embarks on a BEPS 2.0 journey or a more towards inclusive framework, we expect that the MOF on a going forward basis may be very, very stringent in terms of levy of penalties, in terms of how the errors and the misreportings in CbCR reports would be looked at. The penalties are stringent; they are financial in nature. As of now, there are no criminal penalties being levied individually on directors or owners or business owners. It ranges from 1 million dirhams, starts from 1 million dirhams, and for every default, there is a different penalty being prescribed by the authorities. In terms of the process flow, we do, what does really happen? There is a lot of talk on, I've submitted the data, now what? Now, typically, if you look at the 2019 data, and that's something which was the first year of compliance, which we had actually, done in the UAE. Now, typically UAE, the MOF generally had timeline till, let's say, 30th of June to really exchange that information with the other authorities. The CbC report gets filed on the automatic exchange of information portal, which is available on the Ministry of Finance website. We upload the XML. If there are any validation errors in terms of any commas, extra spaces, special characters being included in the data sheet, it throws up an error. We validate those errors. We rectify those errors. that goes to the Ministry of Finance. Now, Ministry of Finance then scrutinizes this data on internal risk parameters, and we'll discuss in the coming slides what those potential risk parameters could be. And once, if let's say upon analysis they identify that there are certain tax risks which emanate from a CbCR report being filed, they would then start imposing penalties upon it, right? It could also be on the basis of data not being filled appropriately, and any other errors which the MOF thinks is lacking in the CbCR filing. There is a specialist appeal committee in the within the MOF which handles these appeals. There is an online process through which the appeals are being managed, and once, if let's say a CbCR report is being tagged as a red flag, that is shared with a partner jurisdiction. UAE currently has 60 active exchange of information agreements with different authorities across the globe. That's where the CbCR data, which the UAE Ministry of Finance believes has certain tax risks based on their risk parameters, would be shared across with the authorities. This is something which is akin to ESR, the economic substance filing reporting, if the viewers would agree that even within the ESR filing, whenever there is a lack of substance and the ministry or the FTA determines that the licensee does not have enough economic substance, that information gets shared with the partner jurisdiction. And hence there is a convergence of the approach of how this data either on CbCR and on ESR gets shared with partner jurisdictions in terms of any tax risk which may emanate. Just a comparative overview of how the GCC has implemented the CbCR regulations in the region. Except Kuwait. Kuwait, interestingly, has not implemented a CbCR regime yet. Kuwait also is not a part of the inclusive framework, the OECD inclusive framework yet. The first ones who joined this was Saudi, the Kingdom of Saudi Arabia and Oman, and then they and Qatar. Sorry, apologies. And after that, UAE, Oman, and Bahrain followed. That's the region. The applicability of the CbCR regulations in the region. There are thresholds, like I said, are more or less the same. It's 750 million euros on a global basis, because CbCR is more like a global document. It gets filed in many, it gets filed in one jurisdiction, but gets used by many jurisdictions across the globe. Hence, the threshold is set. It gets just translated into a local currency.
Kapil, interestingly, we all know that the threshold for CbCR is uniform across the world. It's 750 million euro, or in converted in US terms would be around 850 million euro, $850 million. You would be surprised that there's one country who did a unilateral act of bringing down the threshold, and countries in the MENA region. Would you like to guess which country it is?
The MENA region could be Egypt. Could be Egypt. Yeah. Is it Egypt?
Actually, so they unilaterally made it 150 million for their country.
Okay. Yeah.
Something application which is there, but that's the way it is.
No, I think that really comes because Egypt traditionally, and in the recent past, has been very, very active in terms of it's strengthening its tax regime within the region, within its own country, and they have very a very strong transfer pricing regime, a tax and a transfer pricing regime, and that's where they're probably leading the MENA region in terms of, apart from Kingdom of Saudi Arabia, they're also leading that initiative, that flag that yes, we are the leaders in terms of how data gets shared, implementation, tax transparency. That's something which Egypt has been traditionally following. Yeah.
Now let's move to the next slide. We've already covered 20-25 minutes. Some quick practical insights, and I can tell you these scenarios we have covered, which Kapil has actually collated most of them. They're all either part of some guidance document of the OECD or some country who has given a clarification. So quickly, let's run through this because I'm more excited about, telling the outcome. What was the outcome? What were the observations that aggregated data? And, it will be like an eye opener for everybody.
Yeah.
And the world should know, or taxpayers should know, that the tax administrations also have this data and they're becoming well aware. So let's run through this quickly. Please, Kapil, why don't you discuss the question and then you and I can elaborate upon it.
So Aditya, I think one of the key things which we've observed while doing CbCR in the UAE is something, and you know it, that this is all about getting data from various subsidiaries across the globe and collating it into a template and reporting it. Now, interestingly, there are different accounting policies, practices being followed in different regions. And one of the key questions which the companies also have been been struggling with is that how do I do it? It's more of a different accounting policy. They could have different depreciation rates, policies, different tax accruals, etc. And how do I go about it consolidating for CbCR reporting purposes? Your thoughts?
Yeah, Kapil, well, as this is a reporting which is being done, so first of all, you have to do it in one currency and try to follow one accounting standard, right? And the one accounting standard which you should try to follow is the one at the ultimate holding company location, that is UPE basically. So if you can follow the accounting standard which is out there, then I think so you are home. You have achieved what is required. See, one thing you have to appreciate, no one is going to do an accounting test, but it's a transparency. This CbCR is emanating out of transparency. So how transparent and how consistent you are. So if you're following a particular format of taking consolidated data to see whether you clear the threshold, and for your reporting, you're particularly taking a data from a particular source, keep doing that consistency. So whether it could be an MIS or whether you're following a particular accounting standard, just follow it harmoniously.
Right.
You can follow that harmoniously, I think so you're home. And when you're a listed company, you will definitely have your consolidated financial data at a ultimate holding company level. So if you have at that particular level, follow that. If you're not a listed company, you're following a particular set of accounting, whether it's GAAP or IFRS or anything else, then you follow that.
True. Agreed, Aditya. Absolutely. The other, and I'm sure the viewers, would also have some questions on threshold determination. Now, typically, one of the key things which companies have come up with is that they've started operations mid-year, probably a June or a July or whatever, right? And it's just a half year. How should I determine the applicability of the threshold on me? I've not operated for full entire year of operations. How do I go about determining whether the CbCR regulations would apply to me or not?
See, Kapil, let's look at it this way. The OECD came up with a template, and then it asked each country to come up with its domestic legislation.
Right.
So each country will come up with its domestic legislation, and then will come up with a set of clarification, FAQs. Like IRS came up with some of the FAQs. Now, if your domestic legislation and your domestic circulars or domestic FAQs don't have an answer to that, right? You go and rely on what is there in the OECD.
Right.
And the OECD somewhere gives you the flexibility. Interestingly, OECD came up with a document that these are the three approaches which are being followed.
Right.
Where you take the actual consolidated revenue from the June to December 2019 period only. So you're taking 6 months, you just say that whether that 6 months clears the threshold or not. No adjustment, nothing. The second approach is you interpolate that data of 6 months to make it 12 months and see whether it clears the threshold. Or you proportionally reduce the threshold. Unless until your domestic country comes up with a clarification on this, go for any of the three approaches and and document that. So there's no sacrosanct. And one thing you would appreciate is that, Kapil, no one basis 1 year would do your tax risk or transfer pricing risk assessment.
Right.
It is always said that people, even if they do a transfer pricing risk assessment, they will observe your CbCR over a period of time to see that there is a shortcoming, there is an observation, there is a data point which is recurring, not a 1 year aberration.
Absolutely.
So if you get missed 1 year also, not that everything will fall apart. So that flexibility is there, and some countries have come up with clarification. So if you see that OECD document, it gives clarification that these countries have followed A approach, these countries have followed B approach, these countries have followed C approach.
Right.
If the country is silent, then you are at liberty to do what you want. One of the three approaches. And if your country comes up with a clarification, because remember, OECD is not a regulation. It is a suggestive regulation, but it has got to come in your home country's domestic legislation.
Yes.
Kapil, we can move to the next one.
Yeah. Aditya, again, one of the key aspects which we've seen in businesses in the UAE is that there is no the subsidiary accounts are not really audited, and there is no statutory requirement per se, either as per the regulatory authorities perspective, and hence from a data collation reporting standpoint, do I need to have get that burden of getting my audit accounts unnecessarily audited? I may just have a small entity having few transactions, or probably just a holding company holding few of the companies below me, etc. And that really has become a pain point for some of our clients, which have really triggered this discussion.
So Kapil, I will let me be very clear out here. Interestingly, you will be surprised to hear that consolidated financial statements, right, Kapil, at times don't report all the entities.
Right.
The materiality in many of the accounting standards in many countries, they skip certain countries.
Yeah.
So CbCR does not allow you to do that. I'm looking at it the other way around. You're getting my point. So consolidated financial statements may still permit you to leave two entities. Here you are not leaving a single entity. Right. Anything that is a part of the group has to be reported here.
Sure. Okay.
Anything and everything which is part of the group has to be reported here. Now, coming to the accounting standards. See, if you are not preparing accounts, you're not following a set of accounting standards, you're not compelled to follow that. I'm sure there would be some level of consolidation which you are doing.
Yeah.
In the MIS, just follow that and follow that consistently and document it.
Yeah.
This is not a test of accounting standard, and you will see in the subsequent question that where there's a question whether I need to consolidate and knock off related party transaction or do I need to aggregate.
Right.
Accounting standards ask you to consolidate and knock off, but here it's simple aggregation reporting of data.
Absolutely.
So don't be so sticky about the fact that I need to follow a particular accounting standard. Follow some consistent method of accounting. I'm sure you're following that. Otherwise, how can your books of accounts work? Right. You may not be reporting that anywhere, but follow that consistent approach. Document that what is that approach and follow that consistently. Don't try to do it in a manner that 1 year I follow this, second year CbCR. Right. And if you change, it should be a change for the better, change for a more wider reporting, and then you should document it again. But try to avoid change.
Yeah. No, and I think you raised a valid point, Aditya, in terms of documentation, because that has been the questions from the Ministry of Finance in terms of, whenever they've targeting companies on backup data. They've been asking, okay, on what basis have you reported these numbers? I think documentation, getting that consistency into place is something which is very, very crucial when we are reporting the data aspects. Yeah, perfect. Now, we've also seen some cases reporting errors. I've done some inadvertent errors. Numbers got missed out. It was more of a typing error. How is there a mechanism to really rectify these errors? Is it something which I can do to really revise my CbCR filing?
So Kapil, there's a due date.
Yeah.
Do as much as you want till the due date. But once the due date is gone, you've lost the opportunity. You lost the window for that year. So before the due date, you can revise it 2 times, 3 times. I know some corporates will revise it 3 times in different European jurisdictions, and those countries gave that flexibility. But it has to be, and in UAE also you can revise it till the due date, but after the due date it cannot be done.
Right. And I think what we've also advised, whenever these cases come up, is that whatever addition or deletion or any changes you are doing in the CbCR, the new revised CbCR, appropriately mention it in the file by way of an additional information or table 3 just inform the authorities that this should be the file which should be now used rather than the previous file. I think that's more of a good practice which the company should follow while doing a CbCR reporting. This is something which is a very hot topic, and in the region we've seen a lot of restructurings happen generally also, and because of COVID times, and that's how people have now started looking at their businesses, that do I do a merger and a demerger. And one of the key questions typically is that you have a company with a consolidated revenue which breaches a threshold, and now there is another company which does not have a threshold. Now B company in our case merges into A company. Now what are the filing obligations for both A and B for a CbCR?
So, Kapil, again, I'm going back to the basics now. The basics is that in the preceding year, if you clear the threshold, you do the filing for this year. Right? So if you're talking about a 21, if you clear the thresholds for 20, you do your filing for 21, irrespective of the fact that 21 you may not be clearing the thresholds.
Right.
The filing of the data will be done taking 21 data, but whether you're required to do that is basis the 20 data. Now, assume your company A was existing with 4.1 billion dirham in 2019.
Right.
In 2020, it was exceeding 3.15 billion dirham. It needs to comply.
Yeah.
B company in 2019 had 1.2 billion dirham. In 2020, it doesn't need to comply.
Right.
Let's follow this most basic formula. Now, so there's no new entity which is getting created, AB or something. Actually, it is A only in 2020. So when you're taking 2020 reporting, you will have the combined entity for the reporting purposes. But the threshold is of 19.
Right.
I'll tell you, it may look like an aberration, but it will happen only for a year. And no one is going to test you on. You stick to the law. You stick to the basics. Follow threshold, follow the preceding year blindly. For the data, follow the current year. Irrespective of the fact whether this year the threshold was clear, that year threshold was clear. Threshold, preceding year data, reporting current year data. What might happen in the preceding year data, you were taking only single company financials for seeing when the threshold. And when you're reporting, you're taking 2 years combined data. No problem. That's the way the law. Just stick to the basics. So, in your question out here, you have given that what if A merges into B? So A is not going to be in existence. It's going to be merged into B. But we will have to do its compliance. Because A cleared it in 19.
Absolutely.
Now, what if A and B both had group turnover less than 3.1 billion in the current year? It is more than 3.15 billion dirham. None of them come.
Absolutely.
Simple basic law. Threshold preceding year, compliance current year.
True. Agreed. And again on demergers, just continuing on the reason.
You will apply the same analogy out here.
Yes.
What you apply for mergers, just follow the same. Sometimes the answer lies in the most basic provision, and we try to complicate things. Here, the answer is very basic. Threshold preceding, don't look at the current year data.
Right.
We can move to the next question. It's the same thing.
Yeah. So in terms of risk assessment now, that's where how the seriousness starts. Probably we've talked about the data, filing requirements, thresholds, etc. But what if let's say a country, one of the ministries identify that, the related party revenues of a particular jurisdiction and the revenue is way too high, and that really is how is that looked at? It could be a low tax or a no tax jurisdiction where the concentration of the related party transactions may be huge. How does authorities look at these kind of structures?
Kapil, there is a question which is there, from Naman. Have there been any audits of CbCR reports?
Right.
So let me tell you, if you are present in 50 countries, you're actually doing a filing of the same document in 50 countries. It's just that to make life easy for you, all the 50 companies have come together and say, Company A, you just file it in the ultimate holding company location.
Hmm.
We take the responsibility to exchange it with the rest 49 countries.
Right.
Now, when you say a CbC audit,
Hmm.
a CbC audit can happen not only from the holding company, can happen from any of the 50 countries. So
Right.
first, mindset that it is going to be audited in one country. It could be audited in any of the 50 countries.
True.
Now, second of all, there is nothing known as a CbC audit.
Hmm.
You have to appreciate it is a risk assessment tool to be used by tax administrations.
Hmm.
So tax departments of these 50 countries where your group has presence, for them, it is a risk assessment. Again, not a tax, but a transfer pricing risk assessment tool.
True.
It means that basis this, they will get an intuitive feeling that, yes, we need to probe you further.
Right.
There will never be a CbCR audit. So there's no provision for a CbCR audit. You'll have a regular transfer pricing audit. This is just intuitive information that there's something going wrong with you and we need to probe it any further.
Right.
After this, we just have a very small session. Otherwise, there's an ICAP. You know, when actually, I think so Procter & Gamble and one of the groups have actually gone ahead and done a multilateral, risk assessment and a clarity on the CbCR, where they went and approached 10, 12 countries together and said that here is my CbCR, here is my filing, here is my information. All 12 countries, you come together and decide whether everything is fine. It's like an advanced ruling which they took. But I'll leave it for a different session, not for today.
Yeah, and I think we're hearing a lot of discussions on many large corporates making their CbCR report public for everyone to look at it, and pure from a transparency standpoint.
That is coming from the EU.
Yeah.
Public disclosures. UK has made it clear. I am open and I will be one of the front runners, but will not be the only one. I don't want to be a scapegoat, but UK, the finance ministry has made an official, HMRC is officially declared also. We are open to a public disclosure of the CbCR, provided we are not the only ones. We don't want to be the only ones. EU, Parliament and everyone is pushing this very strong to make it a public disclosure. That debate is for a separate forum. Again, not for this, otherwise we'll lose track.
Yeah, perfect.
So on your point, yes, related party transactions could be, but there's nothing known as, I want to clarify, taxpayers, there's nothing known as a CbCR audit. There is a transfer pricing audit, and that is all what will happen. Not a CbCR audit. There's nothing known as a CbCR audit. This is just for tax officers and tax departments across the world where your group companies have presence, to get an intuitive feeling that something is wrong with you. But basically, you cannot face an adjustment. It is clarified by OECD, it is clarified by IRS, it's clarified by EU, it is clarified by most of the tax bodies, regional tax bodies, global tax bodies, everyone. Because if an adjustment and audit happens basis of CbCR, you are actually pushing a formulary apportionment method, which is defeating
the arm's length principle.
And if you defeat the arm's length principle, then in action point 13, there were 3 documents: a CbCR, master file, and a local file. The local file and the master file are basis the arm's length standard.
True.
This is nothing but an intuitive document.
Right.
We can put the next question, please.
Yeah. So again, same kind of a challenge that, there are a country identifies that there are certain jurisdictions which may have significant amount of activity with low levels of profit. I could have, let's say, for example, a UA headquartered company having manufacturing operations in China, but let's say
I can park this for my next part of it. What is coming, because I think so. Your risk assessment 1 question and 2 will be better answered when you see the data which has been aggregated by OECD and the IRS and made public without naming the countries, without naming the companies. They have been aggregated and shown. And that is very interesting observation. All that you have to do in that aggregated data is assume that was a company data. And then you realize how your tax administrators across the world, all those 50 countries. So please don't worry about it, CbCR audit. Be concerned about your transfer pricing audit. The local files have to be very good in quality. CbCR is just a risk assessment tool.
Agreed. And I think this is something which we discussed, briefly in the past, in one of the previous slides, that how does consolidation work? How do I look at the threshold? Is it an aggregation of data or a consolidation of data?
I got your question. Let me put it this way. For the threshold, you take consolidated data. For your reporting on table 1, you follow aggregated data. So you don't knock off related party transactions.
True.
So let me be very clear. For threshold, you take consolidated data. That is preceding your consolidated financials, the revenue. That is the only data you take consolidated. Rest all data which you report in table 1 is all aggregated data. Because they don't want you to walk the path of an accounting exercise.
Right.
So they don't want sub-consolidated data country-wise, and then that is consolidated further on a global-wise. They are not wanting us to do accounting. They are wanting us to do some intuitive, high-level, again I use the word high-level, that is part of OECD's document. High-level intuitive analysis for the tax administrators across the world. Is there something wrong with you? And let me tell you, this CbCR is a precursor to Pillar 2. And there's too much of coincidence. The threshold for a Pillar 2 is 750 million euro. The threshold for a CbCR is a 750 million euro.
Right.
The Pillar 1 is sort of sharing the profits with the consumer locations. The Pillar 2 is the ultimate holding company location trying to pull the profits towards itself. So Pillar 1 is a giving by the parent company, ultimate parent company. Pillar 2 is extracting and bringing it back to my country.
Right.
It's a give and take.
Interesting. Please. So we'll just spend a minute on this. I think they've, the authorities have really looked at some of the common errors, which the companies have made while making their reporting their CbCR data. They've talked about, the total revenue is not reconciling with the unrelated related party revenues, not adding up. Dividends have been, it's more of an appropriation of profit, but has been included in the profit and loss before tax. That's something which has been, happened. There are some non-consolidated constituted entities which have been left out while preparing CbCR, which ideally should have been. Multiple currencies have been looked at while preparing CbCR. There have been excessive rounding offs on certain data. Data has been put into wrong columns, and there are some of the, or probably a TIN number, which is not really a prevalent thing in the UAE, because it's not a VAT registration number. The TIN number is not a VAT registration number. It's a tax identification number given by entities in the jurisdictions. That has not been reported or reported wrongly. So these are the common errors which I think companies should take care of while filing the reporting data. And I think Aditya will just skip to the other part where the statistics are discussed, like you said, the OECD and the IRS reports. Let's spend 5 minutes there, because I'm just conscious of the time. We will have less time for the Q&A. Yeah.
So the OECD published the first year of filing was anything after January 2016, whose year ending was or year starting after 1st January 2016. So roughly 4,000 MNEs filed in 26 jurisdictions, and all of this data was aggregated, and it's all anonymized, so you don't know which company, which jurisdiction. But some interesting observations come to surface, like MNEs in investment hubs reporting a relatively higher share of profits compared to share of employees and tangible assets. Please click on that slide, and I would like to. Now, if you look at this slide, and this is data published by OECD. So when you see high income means countries like US, Japan, the developed economies. When you say middle income, would be countries which are developing economies. The low income are the poorer economies. The investment hubs are the islands, Belgiums of the world. Dubai, Singapore,
Mauritius.
Mauritius, yes.
Yeah.
The stateless economy. So if you see in the CbCR, and we can have a full session on what is stateless, because the definition provided by OECD for stateless is very counterintuitive, because stateless, from an intuition perspective, would have been linked to something where it's not being taxed, but somehow that was the intent. When the definition came, it came something different.
Right.
So I will leave that for a different session. But basically, these are low tax countries. Let me put it this way. and investment hubs are low tax countries. Now, if you see the dark bar, right, that is the tax. The light blue bar, where there's a tick, you will see, is the profit.
Right.
Orange bar is the number of employees, and the light green bar is the tangible assets.
Wow.
Closely observe, the developed economies have the highest number of employees,
Right.
and the highest number of tangible assets.
Right.
So the highest number of tangible assets are in the developed economies.
True.
The next level where the tangible assets are there are the middle income and the investment hubs. But the number of employees, if you see, are in the developing economies.
Right.
That means non-capital oriented outsourced work is coming to the middle income, developing economies.
True. True.
That is some of the Asian countries and Sri Lanka, India, and many of these countries will be the middle income. That is the developing economies, Brazil. So you will see it's not capital intensive, but is labor intensive. So number of employees is very high. Right. So middle income, high number of employees.
Right.
Go to high income, high capital intensive, tangible assets at its peak. But when you come to profits, the profits are there in the developed economies, that is the US, Japans of the world.
Right.
Right.
Or in the investment.
Yeah, or in the investment hubs and the stateless.
Yes.
This is always compared to the number of people.
Yes, absolutely.
So who's the loser? Is the middle income.
Yeah.
So the headquarter companies are still getting their fair share.
Right.
The investment hubs and stateless economies, that is Belgium, Ireland, Singapore, Mauritius, these countries are benefiting way much. The ones who are losing are the developing economies. There the share of profit is the least.
Right.
So what is happening, actually, there is a migration of wealth from the middle income to the investment hubs and stateless.
Right.
Still, the developed economies somewhere know how to extract their fair share of profits.
True.
We can go back. So this is a very interesting observation. And basis this, now they're going to target the stateless and the investment. So that question which someone asked was a CbCR audit. No, it's a transfer pricing audit. And here, if you're in a consumer country or a developing country, there the administrators would want to target.
Yeah.
And here you link it to the pillar 2. The pillar 2 actually helps that take that money, not go to the consumer country, that is a developing economy, but to the developed economy actually, where there is a reasonable share.
Agreed.
But they've agreed in pillar 1 to part with some portion of the income for the consumer economies.
Agreed.
So that's a trade-off. I know, Kapil, it's a very complex thing, but it's a very interesting economics. So tax is just not a provision, but tax is economics.
Economics. Agreed, Aditya.
Let's move to the next one. The revenue per employee tend to be higher where statutory rates are 0. Interestingly. So if you
Again,
see
the investments hub have the highest. Yeah.
Revenue per employee is the thickest in the investment hubs, including higher than in the developed economy, which is the high income economy.
Right.
That means per employee, the amount of profits which are being parked there and the revenue which is being parked there is very high.
Yeah.
The stateless economy is little lesser than the investment hubs, but still modest. But it is still there. So this is the cause of concern again.
Yeah.
Now, who will go behind it? Whether the middle income or the high income, that is to be seen. Because the middle income are the consumer economies and the high income are the developed economies.
Yes.
Again, the share of related party revenues is very high for the investment hubs. Look at the amount of related party transactions. So please expect transfer pricing audits if in your CbCR reporting, when data is plotted in this manner, and you find your investment hub has a high proponent of related party transactions. So this is aggregated data, but just imagine if it was data for your company. And it is plotted in this manner, developing low income investment hubs and stateless.
And I think, Aditya, what is interesting is this is how the authorities have started looking at the data. While we've just submitted a template, this is how graphically they're now looking at plotting the data analyzing and probably will start challenging other companies on.
But again, Kapil, OECD is very clear. There is nothing known as a CbCR audit.
Yeah.
Whatever has to be picked up in a transfer pricing audit.
Agreed.
Well, Aditya, hi, sorry, we'll just have to be mindful of the time, and maybe we can just pick up some other relevant slides. And
I would want to just pick up one more slide. This and two more slides. Just you have to give me 3-4 minutes. Kapil, can you go to that last slide? And that is very important.
Yeah.
So what do these investment hubs do? You would see that they are holding shares.
Right.
And the other location which is holding maximum shares is the stateless economies.
Right.
I think so. That is a very big indication that why the money is lying in the investment hubs and the stateless economies. Interestingly, I was expecting, because in table 2 there is data for intellectual property activities also, but somewhere it is not featured in this analysis. Because if that had featured in this analysis, it would have created anarchy.
Yeah.
Now, Kapil, moving to so the similar data was analyzed by CbCR for its 1600 filings, and 3 quick slides. It will take 1 minute each of these. Move to the next slide. I'll just simply run through. So this is the aggregate data for the 1600 US filings done in the first year. It clearly shows that the 43% of the profits are residing outside US and 57% of the profits are in US. So, the 1600 companies who did the filing, 57% of the profit sitting in US, 43% of the profit. So definitely US is a super globalized economy where 43% of its profits are coming from outside US.
Right.
So what next? What happens to this 43%? Let's look at the next slide. Out of this 43%, 65% is sitting in tax havens, tax favored location, and stateless economies. That means for any US corporate, $100 of profits, 43% is outside US, and 65% of 43. That will come to around 27%. That means on 25% of its global profits, it doesn't pay taxes.
Wow.
And that is why, if you move to the next slide, the ETR for US corporates, which is in the next slide, you just is 10%. Now under Pillar 1, it shares a part of these profits with the consumer location, that is the developing economies.
Right.
Under GILTI and Pillar 2, it pulls it back.
True.
So how you're guilty in US, your Pillar 1, Pillar 2, how all of this, but thankfully Pillar 1 is for very large companies, which is 22 billion and above in revenue. So I will leave 22 billion, the larger Pillar 1 aside. But for Pillar 2, it in hand, actually, it is just an extension of GILTI. It is trying to pull more and more profits back into this.
Yeah.
But actually then the developing economies are fighting back and saying, well, that money is actually ours.
Yeah.
So that's why the debate. So this is something where your transfer pricing audit, and I'm saying that CbCR is just a precursor for your Pillar 2. Because what is Pillar 2? Pillar 2 says that if your tax rates are lower than 12.5 or 15, that a consensus is yet to be achieved. That in a particular country, if you're not the statutory tax rate, but your effective tax rate, that after incentives and all said and done, what is your tax you are paying in a particular jurisdiction? If that comes down to less than 15 or 12.5, a large part of it will actually go to the home country. That is the ultimate parent company.
Right.
Obviously, there's a formula attached to it. There's some part which is shared with the local countries, the consumer countries also. But a substantial part actually flows. And what was GILTI? GILTI was also something similar.
Yeah.
So,
yeah.
Interesting coincidence, Pillar 2 has a threshold of 750 million. CbCR has a threshold of 750 million. The outcome of a CbCR is the ETR, which I showed you in the US IRS report. Pillar 2 starts with the ETR being lower than 15%. So you have 1 year of CbCR filing with you. Please start getting prepared. Take it, although the ETR computation for a Pillar 2 and a CbCR may be different. That is yet to be included, but it is a very good starting point to start working on a Pillar 2. I think so. This is I will close on this. And Kapil, why don't you speak on this? I think I've spoken.
No, I think Aditya, you summarized as well, and obviously now is the time that the companies cannot look at their CbCR data in silo. It's a big ticket item. It's a precursor to Pillar 2, and I think a lot of care has to be done when we look at a CbCR filing. We have to start early. We have to look at what we've done in the past. We have to look at our past positions, any accounting inconsistencies. We should get all the stakeholders in consensus in terms of what gets reported to the authorities. That level of detailing needs to be done. SAP differences will need to be looked at, because if, let's say, the Pillar 2 provisions also kick in, then typically how do we blend the global minimum tax rate into the system is something which needs to be looked at. So a SAP readiness program needs to be looked at. We should have these red flags, like you said, this graphical analysis of the investment hubs. That is something which the company should look at their operating structure. Look at where could be challenged on an audit perspective, from a transfer pricing risk audit perspective, and do I need to restructure my operations? And probably, obviously, like I said, have a holistic view of the entire data, not really look at it on a jurisdiction wise, entity wise, on a silo basis, but probably from a 360-degree review. Yeah.
Deepak, we have one or two questions. Can we just attend to this question, or you would want to close the session?
Maybe I think Aditya will close. Maybe we could write back to the people who asked a question. Extremely sorry for that. But thank you so much, Aditya and Kapil. I think the presentation was really insightful. And from my perspective, I think the take home was the fact that the US companies are not really paying their fair share of taxes. Thank you so much for everyone for joining this webinar. I hope it was useful. And we'll be, as I mentioned, we'll be sharing the presentation and also be answering to the questions that we've got. Thank you so much again, and we hope to see you again. Have a good day. Bye-bye.
Thank you. Bye-bye.